here for a possible buy, but there was a better buy when we started to see these pins coming in here. You can see we're getting a short term and a long term in place here. Remember, if the short term is against you, so we can see that this 3 in a line along this price is in place. You can see the value is diverging on both of our value lines. So that 3 in a line there is valid. However, you see the difference. The short-term value is against us. Does everybody recognize this storyline? That short-term localized storyline is more important for you guys than the macro storyline, right? So whilst we have significant value divergence, so when we look along that line and we start seeing that we've got that type of value divergence there, this is a great idea to buy it, but not on the way down. This is the kind of trade that you buy on the way back up because it's the localized story is bearish. Why would you buy it when it's bearish? Unless it's what? Unless it's a guaranteed discount, right? Unless that price is a guaranteed discount. Well, a guaranteed discount technically doesn't exist until we're down here, right? So you could put in your passive bids down here and, you know, you might get filled, you might not. But obviously your passive bids are resting there on the basis of a guaranteed discount price. So that's where your passive buy is. So you can't buy it pretty much anywhere else. So in other words, if you take out the low of the prior low, you may well be able to get a Heisman, which is a buy stop, which is an aggressive order. You may well have that type of trade, or you can wait until the value starts turning bid. As soon as the value starts turning bid, you would then have to cross in as aggressively as you can and take advantage of the macro value, which means you're probably going to end up getting filled around about here. Would that be reasonable? But do you see the difference in how those trades behave? So your buy trade comes in at that stage there on that line right there. Whereas when you see this type of trade here, this has got a lot of value. So I can do the buzzies on this trade. The macro's bullish, the local value is bullish. So when the price, I've got a little swing low here with that pin rejection, I can start putting in a couple of buzzy bids in at these prices here because I'm also willing to cross the spread as well. I'm also willing to cross the spread. In fact, I'll take any trade I can get at this stage as far as a long gold is positioned. So I can obviously buy into that as it dips down, or I can cross the spread on the Heisman and buy as it moves off the bottom edges. Do you see the difference in those two trades? And it's very, very, very important that we recognize that there is a difference between those two trades. One's got a localized bid and one's got a localized offer. If it's a local offer, I want to get a guaranteed discount price, or I want to see the price flip. I want to see the other price flip. Now, that's just based on these, of course. You know, so you've got to try and recognize the value when you see it. You've got to try and recognize the type of value when you see it. Now, as we go through the process of filtering out whether we wanted to take that trade, let's take a look. So at the time of the trade, did we want to take the trade? Well, there was a couple of real challenges. The challenge we had was at the time, you can see in the background, let's just take a look at these. There was the dollar challenge. Now, the dollar challenge was not bearish. We did see some macro divergence and some micro divergence. We're not really getting that divergence at that price, though. So we're not getting a great trade. We're not getting a bad trade, but we're not getting a great trade at that stage. So I don't think I want to be crossing too aggressively. I don't want to be crossing to take advantage of this one. I want to be passive. I don't want to be chasing this bad boy up and down the charts here. If we go into trying to find the other value that was in it, the idea, of course, is that we're trying to find a better trade on the silver. And simply, it doesn't exist in the initial phases. You're obviously looking to see the blue line dropping, which then does come in. You can see, obviously, this is what caused the drop in the first place, which is why you probably wouldn't have crossed the spread regardless of the dollar in that trade. However, when this starts to fall, well, this becomes what we call an arbitrage. This becomes an arbitrage. So that builds an awful lot of safety into that trade, doesn't it? There's an arbitrage quality about that trade there. The pink line and the blue line are both falling. Well, we know that if the pink line and the blue line fall, That's an arbitrage, so long as the candle is red. It's very much like this arbitrage here. There was a big arbitrage in there for that buy trade at that stage there, wasn't there? So we can add a bit of value to this. We can add a little bit of safety to this by seeing the arbitrage visibly appearing. And that obviously allows you to go ahead and work into those buzzy type levels. Now the takeaway from the trade actually was pretty brutally good. You can see a very strong takeaway, and then obviously we lost the value there. We got a bit of a snapback on this candle here, and obviously that's your exit price. So you started to recognize that your exit was right there. That's not a bad takeaway, guys. That's $400, Reeve. That little trade there was $400. You were in the market for 5 minutes. It's not a bad little trade, isn't it? It's not a bad little bit of business. Now, was there a sellable opportunity in here? Well, we can obviously work our way through the last rotation. You can see that the swing high, swing low, we never got up to the target price there. So you never got what we would have looked at as a guaranteed premium. But if you look in the background, you were already aware that we had this swing in the background anyway, and this was a top right-hand hold. And if you look at that swing there, you'd have been looking at this price area as your target price, right? That was already your main target price for all of these buy trades, was this price here. So you already had knowledge of this price. You already were aware of this price. And when you saw the value building massively into that same price, you're starting to think to yourself, well, okay, is that dollar that was causing us problems here now beneficial for the sell trade? Let's take a look and see if it was beneficial for the sell trade. My God, it was really beneficial for the sell trade, wasn't it? So whilst it was against us for the buy trade, and the only reason we got the buy trade was because of the arbitrage, it was actually really in our favor for the sell trade, and it was a guaranteed premium, wasn't it? Would you agree with that? That's a guaranteed premium against the buck. So that's a guaranteed premium sell trade right there, right? The value has not gone any higher. In fact, it's not gone any higher. It's massively declining, which gives you a guaranteed premium at that price level. Now, in addition to the guaranteed premium, which we've now established, we'd already checked out this narrative, and obviously the blue line's rising and the pink line's falling. I mean, you can't get much better in terms of macro value than that. That's enormous sell side value in that trade. So you've now got a guaranteed premium short, measured move into the level, with a very strong silver narrative in the background. And obviously what you're hoping is that we've got a little bit of blue line divergence creeping into it. And again, the blue line, whilst the local is bullish, remember what we said about the localized trade being bullish, but we're at a guaranteed premium? Well, that's exactly what's happening here. The blue line was actually no more bullish than it was before, really, was it? So that's what we call a guaranteed premium. So that is a passive sell, correct? It's not brilliant. We don't get the short-term sell, but we get a guaranteed premium sell. And sure enough, we've just sold 71.5 and we got all the way down to 68. Another $350 on the sell trade. You see that? And that is huge. Back to the halfback. The value goes away from the trade, doesn't it? Back to the halfback, and the value gets dissolved into that halfback trade there. And you can see that the buyers came in strong from the halfback with the value still bullish and rattled the price back through the top edges. It's one of those easy to recognize trades, easy to recognize narratives. What you've got to do is, first of all, recognize them, know what you're looking for, and then execute against them. And as I said, you know, when you start looking for these, what you're trying to do is you're trying to find relative value. And all you've got to do is draw straight lines, guys, because if you're looking at that relative value there, I can already recognize that there was relative value. Look at the red line. Red line's rising. Look at the blue line. Blue line's rising even more. So there is localized value here to buy it. Correct? Correct. So we've got localized value to buy into that storyline. If we look at the pink line at that price, you can see that the explosion by the pink line puts the pink line above. That's what you're looking for. You needed to see that. And then the pink line dropped and the blue line dropped. What does a pink line dropping and a blue line dropping mean? Everybody knows this that trades gold. It means it's an arbitrage buy trade. So when you've got the pink line dropping and the blue line dropping on that red candle there with a big pin attached to it, it means that that candle is getting arbitraged, which means that that next trade there is an absolute walk in the park. You get a snapback on the next trade beside the arbitrage, and boom, straight off to the races to the upside. Difficult? No, we're going to be focused this whole week on these trades, so you better start picking up on them. I'm assuming that everybody sees that as an easy buy opportunity. In fact, the drawing in of the level would have made it a good level that you'd have been asking a question about in the first place here. Crazy good opportunity, guys. Crazy good opportunity.